It is a pleasure to be here tonight.
Good, fantastic. So I was thinking maybe we could start. One of the things we try to do here when we get the opportunity to talk to folks like you, who have built, major companies, major institutions from scratch. Obviously that you've kind of done that in a different industry from the one that Ben and I usually operate in, but anybody who creates something of the scale and scope of a Citadel is, somebody we're keenly interested in kind of hearing the story from. So I wanted to start by maybe asking you, could you maybe just start out for people who haven't heard of Citadel or don't know what it is, maybe give us kind of the one paragraph kind of thumbnail sketch of what it is, and then I'll ask you to kind of tell us about your origin story and then the origin of the firm.
So Mark, Citadel and Citadel Securities are two of the largest participants in the global capital markets. Citadel is the firm that I back in 1990 that was very early at using quantitative investments in the financial markets. I had a background in software engineering. I was incredibly fortunate. I grew up in Boca Raton, Florida, which for the computer science history buff, IBM personal computer was developed.
Mm-hmm. Right.
And had one of the first PCs that came off that manufacturing line, which meant that I had to learn everything from assembly language to programming in BASIC or in later in C++. And so I had a really just passion around the technology in the very early days of accessible to the average man on the street. In college, I studied economics and found that my passion around technology, around mathematics, could be applied in financial markets by building quantitative models to price various options like convertible bonds, like equity warrants, instruments that were a bit more esoteric, but where Wall Street had really yet to embrace the power of quantitative finance. And that was the origin story of Citadel back in 1990, was this belief that we could change how financial markets around the world worked by using what you and I today think of as almost commonplace tools and technology, but in a way that at the time was quite revolutionary.
Right. And how old were you when you started to kind of decode that there was maybe something big that was about to happen like that?
So I started to invest my freshman year in college, and it was really my sophomore year in college that I stumbled upon the arcane world of convertible bond. And in that world, I saw the opportunity to apply these concepts of quantitative finance in the financial markets. And so that was all the way back in like 1987. So quite a while ago.
I think normally one would assume, I guess we're all kind of used to thinking about Wall Street being very sophisticated, and obviously it is in many ways. I would have thought, I guess, even in the 1980s, I would have thought that what Renaissance was up and running by then. Is that right?
I want to say they focus on statistical arbitrage strategies in the early 90s, if memory serves me right.
You were there quite literally at the beginning then. The whole quant kind of phenomenon was just in the very nascent stages generally.
So what you found the large investment banks had built these capabilities in the fixed income product space. So for example, trading treasuries. You saw firms like Princeton Newport Partners that were in the space. But it was a variety of people who were off the Wall Street that were really starting to appreciate how the unfolding world of technology was going to change the financial services landscape.
Right. Yeah, there's a famous story. I don't know if you ever knew him. There was a guy, Ben Rosen. Did you ever meet Ben Rosen by any chance?
I didn't.
Okay, yeah. So Ben Rosen was, I think I have the story right. He was a legendary analyst for Morgan Stanley covering tech in the early 80s, and he's kind of the guy who basically he's like the guy who basically announced to Wall Street that the PC was coming. Back to your reference.
Yes.
And he wrote this research report, and he basically said there's this new thing called the PC, and everybody thinks it's basically stupid and useless, but there's this new software thing that's been built on it called the spreadsheet. And I think it might be a big deal. And of course, not only was he right about that, he went on to actually found a very large and successful computer company called Compaq.
Now that you mentioned Ben's background, I have met Ben before, and he was absolutely a pioneer. And of course, the Compaq personal computer, the portable computer, was like lugging your suitcase around.
But nevertheless, was a big breakthrough right at the time, right?
Extraordinary.
It's like a 35-pound briefcase with like a 4-inch screen, in the original model, and
a 5 1/4 inch drive. So this is where we're dating ourselves, okay? Just to be really clear.
Yeah, exactly. So that was right in that era. And then the other interesting thing about your time frame on this is, so you were in the market as a, I guess, 19-year-old college freshman in 1987 during the famous, what was it, Black Friday crash of 87?
The crash of 87.
And so what was that like to experience, especially as somebody who was just getting started in finance?
It was an extraordinary moment to experience early in one's career. And I think it was an incredibly pivotal moment because having not deployed much capital, I nonetheless I had to see the carnage that the crash of 87 created. And moments like that create great respect for how markets can be incredibly volatile and turbulent.
Yeah, and the way I've heard it described, and of course I've been through a couple of these now, but there's this whole concept of sort of like a liquidity crisis, right? Which is basically, it just feels like basically the tide goes out, right? Participants in the market simply do, they either all want to sell or they don't want to trade at all.
So back in the late 80s, there was the theory of portfolio insurance. And you could have a large equity portfolio and manage your downside risk selling that portfolio as the market went down in price. And the only problem with this strategy was that there was so much money deployed using this strategy that when everyone tried to sell at once, there was simply no buyer at a brief period of time. And that really fueled the crash of 87.
Right. Yep. Yeah, exactly. By the way, people haven't read the original paper on portfolio insurance. I read it a while ago, and you read it and you're like, wow, this sounds like a great idea. Why doesn't everybody do this?
Yeah, the old pathological condition.
Yes, exactly. So Ken, take us from that. Okay, take us from then those early days. And as with maybe Ben and me and a lot of people listening, like there's sort of obviously a right place, right time kind of aspect, but also like how did you go from that to deciding to start your own firm, Citadel?
I'd like to sort of take right place, right time, the right toolkit at the moment in time to solve the problem that had yet to be solved. And I think an incredible number of our stories of great entrepreneurial success really come down to having the right toolkit at that moment. And I think it's an important distinction from right place, right time.
Well, and then the other implication of that, though, is that the incumbents, presumably the incumbents have just as much access to that toolkit as, a new entrant like Citadel does, right? And so if you have the part of that puzzle then is why the incumbents don't immediately seize on the new toolkit.
But I think you've been doing venture capital long enough to know that innovation often takes place outside of the four walls of large companies. If you're a large company, you have incredible inertia or momentum in what you currently do. And to embrace a game-changing technology or framework is really difficult to.
Yeah, I think we would call that in your world probably right product, right time. In the sense that, all the big companies could build that product too, but they don't.
But they don't. Yes. Yep. Okay, and then Ken, how did you think about what business did you originally envision Citadel being in?
Well, ironically, when I was certain I'd end up in private equity, and it's been about 30 years, and I have yet to make that journey.
And so, why was that your original thought, and then what happened?
So I was very interested in what it would take to run a great business, and the opportunity to be involved in a portfolio of businesses, to think about how to improve those businesses, how to better the products, how to run the business better, was incredibly fascinating to me. But once I commenced a career in trading and then started to build the business of Citadel, that became my passion.
Right. You could exercise that. Would you say it's still true to this day? It's sort of big finance, capital F finance, private equity, and sort of public markets are still like it's. Is this still the case, basically, that the great private equity firms are not necessarily great public investors, and vice versa?
It's two incredibly different skill sets that drive the success stories of your Fidelities and capital research versus your KKRs and Blackstone. And those differences in skill sets are important to helping us as a country allocate and to corporate America to be competitive on the global stage.
Yep. Okay, and then maybe take us through the first few years of Citadel. Like, what were the steps involved in getting the company up and running?
So, The most important steps involved were one was raising capital. And as you and I both know, founders without capital don't tend to go very far.
Yep.
And I was very fortunate to have been backed early in my career by a firm called Glenwood Partners here in Chicago. They were instrumental to the success story of Citadel, and that the two principals were willing to put their name on the line to investors to support what we were hoping to build here at Citadel. And then the second incredibly important factor was the willingness of people across Wall Street to take the time to explain and mentor me in the various concepts that were applicable to our city. And this is a really special part about the culture of America, which is of people who are more advanced in their career to take the time to mentor literally strangers. Like if you present an interest in a problem and you present it well to a number of people who are leaders in their field, they'll take the time to walk through what their learnings have been, their observations have been, and to help you move ahead in your. And I was incredibly fortunate to have many people at the large investment banks that would take the time to explain to me market opportunities, pitfalls, how I could be a better investor.
And is that, in your view, it sounds like, is that a distinctly American phenomenon?
I think that's an incredibly American phenomenon. You know, go ahead.
And do you think it's across industry? We have that in tech as well. But I've kind of heard, from some, in other industries, it's not as prevalent.
My suspicion is it's pretty broad-based. I would be hesitant to believe it's a tech or finding to think it's an American trait.
Another question I wanted to ask you about the early years. So I remember 1990 quite clearly because I was in college and doing a lot of my original work at that time. And 1990 was a grim time for America, right? It was or at least how I experienced it. It was a grim time for the country. It was the sort of Great Recession of that era was underway. There was this sort of very potent, like, rising political tide of populism, that led to, Ross Perot almost winning in 92. There was this sort of overwhelming feeling, or at least I can tell you in tech, there was this overwhelming feeling at the time that America's best days were behind it, and that basically Japan, at that time was sort of fated to take everything over. There were all these best-selling books talking about how Japan was the future of everything, and the U.S. was basically stagnant and failing. Stocks, I don't remember exactly what was happening in the stock market in 1990, but it probably wasn't all that pretty. Did you feel like you were doing something kind of counterculture in making a bet fundamentally on a system that a lot of people at the time were very down on?
It's a great question. So graduating college in '89, working to invest capital during things in loan crisis was a set of challenges I anticipated, obviously. And then you and I remember, every way or another was about rising sun, the rise of Japan, how Japan was going to dominate every single industry around the world.
Yep.
And we were actually a very active investor in the Japanese derivatives markets, largely because the Japanese had little understanding of the products that they were issuing to raise capital. And I actually took quite a bit of pride in being quite successful trading their markets and bringing some profits back home to America.
Those were the days. It was, I don't know, what was it? It was like, if the 10 big global banks, it was like whatever, 7 or 8 were Japanese.
That or the Imperial Palace in Tokyo was worth a good portion of the entire value of the state of California.
Yep, that's right.
These were moments that are hard to even comprehend in any sense of the word. I mean, like how can you imagine the wealth that was in Japan on paper, and then how that tide pulled out and really left the United States in a very enviable position just 10 or 15 years later.
Yeah. Well, it was like by 1995. My memory is by 1995 it was if that had never happened. Right?
Yes.
The U.S., the sort of U.S. 1990s economic boom, tech boom, internet boom were underway, and the whole Japan thing just went straight down the memory hole.
Well, it did, but it didn't. So just-in-time manufacturing, that came from this moment in time. The entire Toyota production system, which has been studied by like every business school graduate, came from this moment in time. So Japan actually, a number of their incredibly controversial ideas to the world, and the best American companies embraced these ideas in their day-to-day business practices and became far better competitors.
Yep, exactly. Good. Okay, and then one final question on the early stages. We'll move on to current events. So, when, if ever, this is kind of a loaded question to ask an entrepreneur always, but like, when, if ever, did you kind of have the moment where you're like, okay, this thing, my company is going to make it?
So I'm going to answer that question second. So we were talking about the early days and how we were active in trading in Japan. One of the best life experiences I ever had was that we ran a portfolio 24 hours a day when I was 21 years old. And that meant that I had to do learn how to extraordinarily talented people to put around me. And it meant that I learned how to trust these people that I had around me. And that's a really important lesson for all entrepreneurs, is to learn how to let go of the reins to people who are really good around you, and to how to empower them to make decisions and to build a business together with you as a partner. And then when did I say we'd made it? In some sense, I'm still waiting for that day.
Yeah. As soon as you declare that, you got to retire.
I think that's time to find a new occupation in life.
Well, we've made it, but there is a turning point. There is a turning point when you stop. Well, I don't know. You tell me. Was there a point where you're just like, okay, this thing is, whatever is going to happen, this thing isn't just going to go under. Like, this is actually going to be a thing that's going to survive. Or is that still something for you that's just that still kind of haunts you, that you just need to like be constantly on the lookout for things that might take the whole thing down?
I'll put this in perspective with a really real story. So November 2008. The great financial crisis. And I literally remember walking into the elevator in my condo building and wondering if we'd be in business at the end of the day. I mean, the entire U.S. financial system was on the precipice of collapse. And if that had happened, we would have gone with it.
Yeah. And how many hours, the action that happened that kind of saved it, like, how many hours away do you think you were at one point, at the sort of worst point?
So I think that if ready for ironies, the Japanese were instrumental in providing capital to Morgan Stanley at the peak of the crisis.
That's right.
And if the Japanese had backed away from doing so, Morgan Stanley would have failed, and I think we would have failed the next day.
Yeah. And by the way, right, not just Citadel, but also General Electric, and then like the rest of the Fortune 500.
It would have been the Great Depression for. And there's a great irony as we started with the story of 1990 in Japan. Thankfully, the Japanese had been great savers for all this time and had that to help provide Morgan Stanley with a lifeline when all of us in our country treatment.
Yeah. Yep, exactly. So, okay, well, that's a great answer. So you and I are blessed then. You and I and Ben and Alex are all blessed to be in industries where we never get, we always have, there's always enough existential risk to keep us on our toes.
I had an opportunity with Jack Welch's right-hand man on human resources, and he was an advisor to me for years, an incredibly gifted man. And GE had a really interesting vantage point on the world because they would buy a company almost every day at their peak of their acquisition binge. And so they saw all kinds of businesses incredibly well run, businesses that they bought out of bankruptcy.
Yep.
And I asked him, what's it like in the four walls of a company that you bought out of bankruptcy as compared or contrasted to a company that was really well run? And he goes, I'm going to give you a story that's going to paint the picture for you pretty well. The great businesses feel like you're behind the wheel of a Formula One car. And you're flying down the straightaway, full power, 220 miles an hour into the curve. and you're just full on the brakes, the car's sliding out towards the wall, and just before you hit the wall, you're back on the gas going down the way.
Yep.
Over and over.
Yep.
And that was, frankly, a pretty disheartening moment, because that's what the great businesses felt like.
Right.
I said, so what are the businesses that you bought out of bankruptcy feel like? He goes, picture a beautiful day in Texas, and you're in a Cadillac going down the highway at 55 miles an hour. That's what the business out of bankruptcy felt like. And everyone asked, how did this ever happen? And I realized then and there that business was about always being on your feet. And this sort of dream that we get to a promised land,
Yeah, you never quite get there. Well, as Steve Jobs used to say, I think aspirationally, the journey is the reward, which I think he meant at the personal level, but I think also is also at the level of the business.
I think it's true for both. And the journey is the reward.
Yeah. Good. So let's good. So we're about over a third of the way through the time. So I want to get to the kind of current events. So and sort of the exciting stuff. So you have Citadel Asset Management, where you invest capital, the sort of way that you form the business and scale the business, and then you have this business, Citadel Securities, where you serve as what's called a market maker, where you're sort of a part of the sort of key trading infrastructure of how these markets work. There is, as you well know, there are many hedge funds and private equity firms and so forth, and certainly venture capital firms that invest for decades and never have their own market making businesses. Yours has been a huge success, which we'll talk about. But what made you decide to get into that business?
So we were at the epicenter of the movement leading to electronic moves. And that played right to our core competency of predictive analytics and of risk management and of scenaring. So again, it goes back to having the right tools to solve the problem of that moment in time. In the 1980s, when I started trading, all your trading happened with people on the floor of the New York Stock Exchange. And today, people on the floor of the New York Stock Exchange, but the vast majority of trading takes place through electronic matching engines that align buyers and sellers in a almost hyper efficient way. And we had the toolkit to build that was going to excel at providing liquidity in this brave new world of electronic and automated trading. And that's the Citadel Securities. Yep,
got it. And then maybe you could describe for people who kind of don't know what this is, and we're going to get into the GameStop saga here pretty quickly. But and I also want to, by the way, introduce our partner Alex, has been on the line, and I want to also let him be asking questions here also. And actually, as background, so Alex is also an expert in this space, and Alex was on the board of a company called Knight Capital, which I think was in a similar business. And so you guys together know a lot more about this than I do. So, what led Citadel at one point, or I think to this day, let's say as we like to say, robust market share, has been very successful in this space. Like, what do you think? What were the things along the way that caused the sort of outlying level of success that you've had in this business?
So I think, first of all, it goes back to, at our core, it's our strength in predictive analytics. It's understanding where the prices of securities are heading to and being willing to commit our capital to help market in the right direction. So if we think that oil prices are going up and airline stocks will be going down, we're willing to commit our capital to buy oil and to short airlines at that moment in time. And we do this on a massive scale around the world. In fact, we trade about 1 in 4 shares that trade every day in the United States, providing liquidity and helping to bring equilibrium to the market by deploying our capital. The core of the business is again, it's the predictive analytics. This sits in a cocoon or infrastructure of extraordinarily high performance technology, because we have to incorporate literally millions of data points over the course of minutes into our trading decisions. And that requires an incredibly powerful computational backplane to do so. And then the portfolios that we instantiate or that are created by people trading with us, we have to manage the risk of those portfolios in real time, and in particular in fast changing market conditions. So think about the start of the pandemic in March of 2020, the amount of information that we had to incorporate into our decision and put it to a market that was undergoing incredible distress.
1 in 4 trades. That's amazing.
Yeah. The scale is gigantic.
Good Lord. I mean, it's a market maker, but still.
Well, and I can say from my perspective, so I remember I was on the board of a company called KCG, which was the merger of Getco and Knight Capital. And Knight Capital was a very successful market maker that had a little trading error, lost $500 million in about 10 seconds, and then basically went under, but was rescued by a consortium of firms. And I remember when Citadel, and Ken, maybe you could talk about this, when Citadel got into this space, I was curious at the time. KCG just kept losing money. It was not a good business. It eventually merged with Virtu. Citadel has done extraordinarily well, and obviously a lot of this is the tech advantage that you brought. But I guess I am curious, like, how did you think about this from, asset management is itself extraordinarily profitable? Like, we love to invest in recurring revenue SaaS businesses. Asset management is effectively a recurring revenue business. If you just manage enough assets, you're going to have a great business there. So I guess, how do you think about the benefits of not combining the two, because obviously they're separate, but just if you think about both of them, how do you allocate your time? How have they both become so successful, even though they're very separate?
Mark?
Yep. Hey, Ken.
Please tell me this is better.
Yep. So far, so good. Sounds good.
Great.
You sound great.
Great. It's a bit of deja vu. There was a conference call that we held during the great financial crisis of 2008. And you're going to laugh at this. We had to arrange the number of people that could be on the call. And we arranged for more listeners than a typical Goldman Sachs earnings call. And right here at the moment of the great financial crisis, where we're going to tell our story of how we're getting through this moment in time, we had an open call. You could dial in to hear us speak, and they actually crashed the entire teleconference system. So it's great to be here in 2022 or 2020 when we can make this work with thousands of people almost flawlessly.
Yeah, our version of that is, the startup team that comes in to present us, and they're doing, absolutely state-of-the-art deep learning AI, big data, like the most advanced quantum computing work in the world. And then, of course, the first 20 minutes, we can't get the projector to work.
Yes. Yes.
So.
Yeah, sorry about that. I guess I picked a bad time to ask the question. So I was saying I was on the board of KCG, which is, kind of merger of Getco and Knight Capital. Knight Capital was kind of a disaster in that it was a leading market maker until there was a little trading error or snafu, and then it blew up. I was always curious why Citadel got into the business, because I think of asset management as being such an incredible business because it's effectively recurring revenue. If you think of a SaaS company, it's like you get the same revenue every year. You're managing lots of assets. It's a lot more predictable. Market making, you're taking a lot more risk. And how do you think about the balance between the two? And honestly, like from the KCG perspective, it's like we kept losing money in that business forever. It was not a good business. You've turned this into an incredible business. So I guess kind of two-part question. One is, how do you think about why, if you could be so great at asset management, why do this other thing as well? And the other is, what has been the secret to success? I know it's technology, but if you can go into a little bit more, that would be great.
So, first of all, I think it's important to be clear that our asset management business is driven mostly by our performance fees, which are our profit sharing with our investors. So when our investors make money, we make money. And when our investors don't make money, we get paid very little. Yep. And this alignment with our clients puts us in a position to be laser-like focused on both identifying opportunities and managing the risks of the portfolio. So unlike most of your traditional asset managers, we're in a very different business in terms of having to be just continually focused on how do you have in the marketplace a competitive advantage in identifying mispriced assets and opportunities around the world. So that brings us back to the core of our market making business, which is around predictive analytics. In the hedge fund, we spend an incredible amount of time forecasting where we think, for example, the price of natural gas will be in the United States, where the 10-year bond yield will be a month forward. Think about that mindset of forecasting future prices and bring it into a very short-term horizon, say the next day or the next 4 hours, and then apply those forecasts in thinking about how you manage the risk inherent in a portfolio that is given to you in your capacity of providing liquidity to the marketplace. So at 100,000 feet, we're in the forecasting business. And in the hedge fund, our forecasts tend to be forecasts that are measured over weeks or months. And in the market making business, those forecasts are thought of as being measured in the course of minutes, hours, or days. But at the core of both of these businesses is very much a focus on predicting what the future will be. So, for example, in the market making business, you'll see technologies like machine learning being used to build your forecasts of future stock return.